Hello everyone, welcome back to another video. In today's video, we're going to discuss how we can use volume to track the activity of the strong money or the big players and use it to an advantage while we are looking at options. So why am I talking about options is because a lot of volume is traded there. Firstly, secondly, a lot of guys like to make strangles, straddles, or even play the trend in an intraday time frame. So it becomes very important, and the levels of options that we can derive out of the volume from the futures chart as well as the options chart are really good in identifying excellent trading opportunities. So we'll go just one by one and see how we can do that. So firstly, as the name suggests, we're going to strictly look into volume on a normal 5-minute chart, and then even on a footprint chart to go deeper into the levels that can hold for us or give us good information and further dwell upon those levels as to how we can play them. So firstly, on the left side, I have the volume profile chart for the bank nifty, and on the right side what we'll use is we'll use the options chart of I'll just tell you how we can choose the strike prices. So obviously the futures and the strike prices would differ a little because the strikes are generally based on the spot chart, but it doesn't matter. You can go and have a look at the spot chart of what it is trading, but the premiums as such, the levels of the premiums, for example, somewhere between 300 to 500 is what we will look at. And one more thing you have to realize is when we are using this particular method, what is generally going to happen is we're going to look at firstly the first day of expiry. It plays a very significant role, and the day before, just before the expiry day. Okay, so for example, if I'm considering this particular series or expiry, it started, the first trading session was on 12th April, because obviously the 11th was a holiday. So I would consider the 12th to be my deciding factor along with 11. I also look at the market context that is taking place. So for example, on the 9th and 10th, I saw an attempt to break out. We've been rallying quite significantly, and we attempted to break out, and then we opened below a lot of a lot of value. So what I mean by value is, if you look at this, a lot of volume was transacted here. You have two POCs that are here, so you can draw this zone like this if you like. Okay, so and we have started trading below this. This doesn't mean we are bearish, but I'm just putting it out how you can build your context and start your marking your levels and then trading them accordingly. Now it might look at the moment that it is hindsight, so that is why we will again look for something on Monday, that is the 13th of April, how we can play I'm sorry, the 15th of April, how we can play something based on the option prices or the levels that we mark on our option charts. Okay, so for example, let's start with this. So the first thing I've done is so that I don't have to go left, right, center, is I have you can see the important areas that I'm going to use volume at are already taken care of by means of this coloring pattern. So first I'll explain the coloring pattern, then I will go into how I have set them up. So red means obviously the volume is at the largest. Now what we're going to do is we're going to look at these areas wherever there is red plotting in our chart. That is it is as simple as that. And if we see the market context playing in our favor, we mark those levels. And the next level is magenta. After that comes the blue, and then the green, and then obviously the gray. Okay, so our eyes would generally go on the reds and the magentas, sometimes the blues. Okay, and now I will tell you how I have set them up. So you can go ahead and set up your charts even on the, you can see the same pattern being followed on the option chart, and this is a really good way to have your levels marked or have an idea of how things are going. So always remember, yes, price is key, but volume precedes price. Okay, so if any move is to happen, you need to have the support of the volume. If it doesn't, the price wouldn't stay at that price at that particular point for a longer duration or a long period of time, and you probably get an absorption and a move to the other direction. So what I mean by that, we'll just go ahead and explain. Now let us first get into the settings, because I know a lot of you guys have the doubt as to how I set them up. So if you see, the first thing I do is I set it up to again, this is volume, and the max value calculation is for the chart session. Okay, you can have it set it to, if you do it daily, you will see what happens is everything is gray, and then you'll have to change the percentage as well. So I have set it to chart session for every chart session, and I have the level value type as absolute and percentage. You can go ahead and select absolute as well. When you select absolute, remember you will have to enter the exact values. For example, if these are 5,000 contracts or so on, you will have to enter that value here. What I've done here is percentage, so it takes care of it automatically, in the sense that whenever the volume crosses 15% of a particular of the highest volume max value, it will pop up in a different color. So this is gray, the next is 25, which is green, the next is 50, which is blue, the next is 70, which is magenta, and so on, and the red is 90. That is why we are considering the reds, because that is somewhere close to the highest volume in the day. So obviously a lot of money has gone there. It can be, I mean, absorption, aggression, we don't know. We will just mark those levels and then use it along with the market context to see what is happening in that particular area, or how it plays out on the same day or the next day. Now why did I tell you that the next thing that we're going to do is we're going to look at the volumes of the options as well. So the strike prices, what we'll generally do is take one in the money. So what do I mean by that? For example, this is the futures chart. We have 48,700. Let's say the spot is at 48,500, and you're looking at a CE strike price. I would prefer somewhere close to 400 to 500. Why am I saying that? Because again, if you're a seller, again, you can go ahead and choose different strike prices, but what will happen is you will not get a play, or you will not get a perfect idea. What this does is, when the premiums are high, the most premium is decayed in the at the money, or just one in the money, and there is where I want to take an advantage of, or have the levels marked. Okay, and if I, for example, if I have a premium that is of 20 bucks, I don't get an idea of where the market can move or how it can move. If on the other hand, I have a premium that is selected for 400 or 500, somewhere close to that, 350, 400, 500, I have a general idea of about 500 points, after which maybe I will change my position, or I'll choose a different strike price. To explain my point better, what I'll do is, let's consider this particular day, these 2 days. Okay, so as you can see that when the red, when we have, is at about on the 9th of April at about 1345 on this bar. And even if you're not using I mean, options or footprint, this should be your reference point always when you've seen this bigger bar. So obviously there was some selling, and there was a POC that forms again mostly because of this bar, and a lot of volume would have been transacted even before that. So this is your sort of reference line, and when the next day the market tries to break this, it fails. It gives you a very good significant move on the upside. So this is your reference point even on a futures chart. I'll just go into options, which is a different strategy altogether. So when I see something like this, okay, let's go into let's assume 49,000 what was this, 48,700. So let's take 49,000 or 48,800 PE. What we have over here is, okay, and let's go to the 9th of April. Okay, and what is this time? This is about 1410. And if we go over here and see the 19th, this is the 14th. Okay, yeah, and 9th of April, and you have this bar, I think 1345, and yeah, this is the same bar. So you can see, when firstly I want to see a confluence of both these. There will be times when you see a higher volume like blue over here and absolutely gray over here. I don't want to see it. Can happen when you've selected a strike price which is way off, but generally if I want to see or mark a level, this is what I want: the confluence on both the places. That is, some money, or a good chunk of money has gone into all the places, that is the futures as well as the option strike. Okay, so I've chosen 48,800. It was about at about, let's say, 350. I would have actually liked to go even deeper at about 400, but let's for example consider this. Now when I see this bar, okay, this bar, what do you see over here? Straight away, this is not an imbalance chart. I will just play out some more things. What I generally want to say is, where has the volume clustered over here, the maximum volume that is clustered over here. Secondly, the imbalance levels. So this is not an imbalance level, that is why I have these charts plotted. You would see they are a little different, wherein I have the volume clusters as well. I mean, we can go ahead and learn how to set up charts like these as well in the coming sessions. But just to give you a general idea, this is what I do. So what we'll do is we'll get the 48,800 here as well, so that we can spot it properly. So this is the 48,000. Let me just get it again. 48,800p. Okay, and what I will do is I will go back to the till the time it sets up. Okay, so we'll go to the 9th of April over here and go to 1345. If I'm not wrong, we'll see it here. This is the bar. Okay, now the 9th of April also you have to remember is that this was the expiry did not start. So you will see, if you just contract this particular chart, and you will see something that the volumes were drastically low in these on the 9th and 10th, again because of what, because the expiry had not kicked in. So generally I would like it to be on the 10th. I will consider the strike price only on the 10th and the 9th to mark my reference levels, but just to have an idea of what we are talking about, I will go ahead and see what has happened on this. Okay, so when the 9th 1345 takes place, it is this bar. Okay, and you see a lot of cluster that is taken place here, and the market holds. If you look at overhead, so I straight away mark this zone. Okay, so this is about 380 to 390, and when I am not able to for example when we are here somewhere here, and the market in the down move, if you see, so people who are enthusiasts in even price action, if you see the up volumes, look at the up volume and the low volumes just drying up, and it's not breaking this zone. Okay, if you look, we will just go deeper into this footprint chart, and if you look over here, the volumes are going down. I've discussed this particular thing a lot of times. In the down move, look at the volumes really dropping, and this particular place where the breakout happened, or rather this is the place. So the first thing when I do when I see one bar, only one red bar, volume bar, is I mark out this volume cluster. So what I'll get is, if not anything, whenever the market approaches this zone, I'm going to get a move to the upside quite significantly, or I'll get my 30-40 points or 20-30 points in an option strike price of 350 to 400 points. I will always, more often than not, about 80 to 70 to 80% of the times, I will get an up move to about 30 to 40 points. Now remember, if a bar like this happens and another red or dark magenta bar happens, and the bar closes the other way around like this on the downside, you have to then mark the areas. If I will see if we can get an example of that. So the first bar is an up bar, the second bar is a down bar. It is generally a shakeout bar. So the volume cluster of both the bars is to be taken into account, and then you mark the reference level of that bar. If you have something like this, the start point or the volume cluster of this point and the imbalance, if you get one, is to be marked. You don't get an imbalance here, but you have an idea of, even if you don't get an imbalance, you've heard me talk, I generally look at these places where the volume clusters and the buy areas are. In this particular example, both are somewhere here. If you look at this volume cluster, so whenever the market approaches this zone and I get sellers getting trapped here, I would generally prefer long if I'm planning to go long in the put, and the areas next areas of interest would be the imbalance zones. Now let's go into the areas that we actually want to dwell upon. So the expiry for this particular contract started on the 12th of April. So let's see on the 10th of April if we did see anything extravagant. That is, you see 1510 bar. Okay, so what happens here is on 1510 is we are exactly at the top, and let's look at what happened at the put at that time. So we were here at 49,000. So I would consider taking up or considering, or let's say a CE option of 49,000 over here. Okay, so let's get this 49,000 CE over here. Okay, I'm sorry, you got the PE over here, so let's get the 49,000 CE over here rather. Okay, now we will see what happened over here, and let's go back again to the bar and see this happened at 1510. Okay, so 49,000 at 10 on the 10th. Okay, and at 1500. So if I see this is the bar, rather this is the bar, okay, 1510. So again I see red on both at both the places, and this is the bar. Okay, so if you see now I have my area marked, so I will consider going or remaining on the short side till the time this area is breached. Okay, so this is how I mark my areas. So I will just go here and mark this area. Okay, this is the area, and we can color it, let's say red. Okay, somewhere like this, and this is the area which I would consider to short whenever the market comes here. Okay, so you see this area, however I come to this area, uh, we are on the top. So if I have to go long, let's say the market did not open a gap down here, or did open gap down here, and we move up and we move above this area, I would consider going into a short trade over here. Okay, so let's see if we got an example of a high volume bar, something like this on the options, and you can go here and check it out over here as well. So you see these green bars, and I'm trying to tell you what I want to see. So obviously these are not red bars, but this is just for an example. So if I see, I was talking about two bars. So if I see these two bars like this, if you see, there are three green bars with huge volumes, and I see these imbalances and the cluster also over here. I would like, as I said, whenever the market approaches this zone, okay, let's expand this. This is too less a premium, but just for explanation sort of things. So when I see the imbalance and the volume cluster very close by, this is a very good entry point for me. Okay, so if you see this zone, this is a very good entry point. Why? Because I've seen good volumes, and this is at about 925. And if you go over here and see on the 10th of April at about 925, you've seen good volume here as well. Look at this blue. So this is a confluence, and whenever the market approaches next in this zone, I am generally going to get my 1:2, 1:3 risk reward, because I have tied up or looked into both the places, that is the futures, and I know a lot of volume has gone into this place. So even if you go and check OI and other factors, you will see these all getting a very good confluence. Okay, so now let's move forward and look at another example over here. So you can go ahead and mark these areas on all types of charts. Now what we're going to do is we're going to look at levels that coming into the Monday, what we can expect. So let's start with the C. So if you are a straddle player, or even a strangle player, or you are trading in the money, or you're trading a credit spread, let's say you're short. So where do you actually start worrying? Okay, so let's again look at the 12th day, 12th of April. So obviously this happens because the market opens gap down, a lot of buyers are trapped if you look at it. So what we'll do is, when the strike price over here was 48, so let's consider 48,500 over here. So we will go ahead and select 48,500 CE over here and see what did we get. Okay, so again, the first bar is the bar that we have a lot of volume, and the other giveaway is that after that we get a good up move. So this is our reference point even on a bank nifty chart, futures chart, that is. Now let's go into the options, that is 48,500, and let us look at the other thing we're going to do is look at the red points in the options charts as well. But what we want is a confluence, that is these reds should coincide with the volumes on futures. At least I should have a blue or a magenta, so as to make some sense or get proper levels. So this is the level. Okay, and we've seen a good red over here as well, and greens after that, and the volume did drop over here as well. So if you look at this place, and you see this is a zone that is my reference line now. Okay, so what we'll do is we will mark this as, again, background would be somewhere red. Okay, and this is the zone, and we will save this as default, so that we don't have to redo it again and again for the selling point of view. So whenever the market approaches here, I am sure I will get one move to the downside, and after that, if the market does break it, we just saw an example. What we want to see is, after that, is the market go up like this, and it will generally take support over here. A lot of sellers getting trapped, and the market will move up, and the next place of interest to us is 545. So if you go and have a look at this 545 level, you will see this is also based on a lot of volume bars. Okay, so if you see, okay, this is one thing that I was talking about. So you see this, it's again on before the expiry kicks in. So this is one day before this particular expiry starts. And if you look at this place, these two red bars, and you see the two volumes bar is one this, and the other one is this, and there is an imbalance that has taken place over here, okay, on the sell side. So this is again becomes a good reference point, and whenever the market approaches this point over here, you see a good move on the upside. This is again an example that we just discussed a few minutes back. So if you're looking for a long, let's say on the call side, this is what you want to see: a lot of sellers getting trapped and the imbalance not playing out. So similarly, the areas that we just marked for the Monday, if we want a breakout, or if you want to go long on the call side, this is our reference point. We want to go on top, and the other reference points that might come into handy are these ones. But again, I wouldn't consider these green ones to be that important. Why? Because the volume wasn't as much. Okay, and if you look at 940 and you compare it to 940 over here, let's go ahead and see what was the volume over here. So yes, it was a little bit on the higher side over here. So yes, you can also consider this zone, but again, the priority should be accorded to places where you saw a good amount of volume. So you've seen green here and green here, so it might act as a resistance, it might not. So the probability will not be as much, because the least we wanted to see is a blue or a magenta over here, which hasn't happened. Okay, the other places where you see a red pop up is look over here. Okay, so this is now this is another scenario where you see the bar closing. If you just see over here, the volume majority of the cluster was here and the bar closing below it, and this is the zone. And the next bar, again, you cannot go long here because I'm sorry, let me just delete this. So the volume cluster was here, the volume cluster that we had on this bar was here, okay, and the volume was really up. 1155 is a red, and let's go and see what happened over here. Okay, so let's go to 1155. You look at the volume over here, okay, and it's red over here, and look at the volume in the futures chart. So there is a sort of you can say I mean, see, there is no confluence over here. So the volumes on the options chart was high, and volumes on the futures chart was not as high. So that is why I said, if you see something like this, that there is a discord between the options and the bank nifty, this move is most likely not going to hold. Okay, and what do you see? So when I see something like this, the confluence not showing up on the chart, I generally prefer not to I mean, enter into the long side. And of course, if you see something, you will miss one or two trades like this, but the probability of your trades will really be high. And what happens after this is, what should again get your attention is, look at this bar. Of course, it doesn't have the volume, and the breakout is just not going through. Okay, the bars are again forming a cluster, and they're failing with this imbalance over here. So again, I have nothing to move forward to. If I wanted to go long here, the least I wanted to target was somewhere to this zone. But look at the impediments that I'm going to face whenever the market is going to go up. Look at these imbalances are always going to act as hurdles for me. That is why I wouldn't enter the long over here. There are a lot of things that are not matching. The volume for one, the imbalance levels just at the top, and so on. The next time we see is on the 12th of April. So this is again the current expiry, and the market has kicked in, and on the 12th 1215 bar. So let's go and see what did we see on 1215. So yes, there is some volume over here. Okay, and what we see here is what we expected over here is this one to hold and give us a long over here. So when the market does come over here, I mean, if you had a 20-30 point stop loss, it would have taken you out, but it did move up eventually for about 40-45 points depending on your stop loss. And when the market does touch this point, even I would have gone long over here, because I did see a confluence of sorts. So if you see immediately what happens is, when this happens, I am waiting for the market to come here and give me a long trade. I did not, I mean, I cannot go long here, because You look at this bar, there is no previous confluence or zone that I can enter from. Of course, this is one place where I did see a long or sort of absorption take place, but again, this I would have waited for the imbalance to come here. And if I'm talking 40 points, I generally keep 20 points, so 325 would have been my stop loss. It would have just hit it and then gone the other way around and hit 85. But again, things like this happen. Should not be perturbed, but it's a strategy that you can play on and look for important reference levels. So moving on to the Monday session, what we've done is we marked the important reference on the call side over here, if you see. And similarly, if you look at the close of the session and the volumes that crept in at the important places, is this 1215 bar like we just saw over here. So this is again one zone that I would have in picture. Although I have missed my trade here, this is a zone that I would take into consideration. Now if I have to go on the long side on the call, okay, and again, these are places 1425, 1440. If you look over here, 1435, there is no volume here. So again, if you're asking me why I have not considered these places, look at the volumes on the futures chart. There is a reason I have not considered these places over here, because I've seen absolutely nothing of significance over here. And on the other hand, a place where I did see some volume on the futures as well as the options chart is this zone that I marked. So 350 is the zone beyond which if I break and I see some action like this, okay, I'm going to continue my long and or take my long rather. On the other hand, if I approach this zone and I see a lot of sellers getting trapped, and the POC here, we've discussed this bar on a footprint chart, I will initiate my short, and my stop loss will be again 20-25 points on the next imbalance zone, and I will target lower, or you can even hold it till the expiry closes if you don't see any significant action above this. Okay, so hopefully I was able to help you guys learn something new today. Until next time, thank you. Bye bye.